Wow, this is crazy. Okay, let's dive right into this because we've got a massive story today. We are looking at a company that is absolutely dominating the financial headlines right now, and that company is CoreWeave. Listen to this. They recently hit an eye-watering valuation, crossing the $19 billion mark. They're pulling in massive credit lines and expanding their footprint all over the globe. But here is the kicker, and this is why we're talking about them. Over the last month, their stock price has actually taken a pretty significant hit. We're talking a drop of around 17%. So what is really going on here? Are we looking at the absolute undisputed darling of the artificial intelligence boom? Or is this whole thing a house of cards that's just being propped up by an ocean of debt? I'm your host, playing the devil's advocate for your portfolios today, as always. Joining me to cut through all of this intense hype is our chief investment analyst. Doctor, what are the real causes hidden behind these wild headlines? Well, let's look at the facts. The data from their recent filings and market activity points to three core drivers behind their massive pivot and the current market volatility we're seeing. First, we have an unprecedented structural shift in enterprise demand. Companies are moving from mere AI experimentation over to full-scale production and inference, and that requires an entirely different, incredibly robust type of infrastructure. Second, we are seeing the execution of a highly aggressive, highly leveraged capital expenditure strategy. We are literally talking about billions of dollars in debt that is collateralized by physical GPU hardware. And third, the market itself is currently experiencing a psychological tug-of-war. Investors are attempting to price a company that exhibits the hypergrowth of a software-as-a-service tech titan, but simultaneously operates with the massive capital intensity of an industrial utility company.
To truly understand the sheer scale we are dealing with here, we have to examine their Q1 2026 earnings report. The single most critical metric in this data is their revenue backlog, which currently sits at a staggering $99.4 billion. Let's be clear, this is not some projected future total addressable market, this is contracted backlog. It represents a 284% year-over-year increase. The data strictly indicates that major enterprise customers are locking in long-term commitments for compute power right now because they are anticipating severe hardware shortages in the near future. Wait, let me stop you right there. $99.4 billion in backlog? That is an astronomical number, especially for a company that most retail investors hadn't even heard of maybe 3 years ago. So, the contrarian question I have to ask on behalf of everyone watching right now is, if they are making so much money, and the demand is that undeniably huge with signatures on the dotted line, why on earth is the stock cooling off? Why are we seeing a 17% drop in the short term? It's proven by the numbers. While the 90-day share price return is up roughly 20%, the one-year total shareholder return is down over 36%. You see, the market is not questioning the revenue itself, the market is questioning the cost required to generate that revenue. Specifically, institutional investors are analyzing the massive capital expenditures required to fulfill that $99.4 billion backlog, and they're wondering whether the enormous debt utilized to acquire all those Nvidia chips is going to compress future equity valuations.
Okay, that makes perfect sense. So we are essentially dealing with a heavy-duty, capital-intensive infrastructure play that is masquerading as a high-flying pure tech play. Fascinating. So, to really get to the bottom of this for our viewers, here is our roadmap for today's explainer. First, we're going to break down CoreWeave's business model and moat. Then, we are unpacking the financial surge. Third, we are going to look at the dark side of this growth, the cost of hyperscale. And finally, we will run through the strict valuation scenarios. We are promising you a rigorous, cold-headed analytical framework today. We are going to arrive at an objective conclusion about your investment, completely stripping away all the Silicon Valley hype.
Exactly. We will rely strictly on the Q1 2026 data and the official source reports to evaluate these 4 pillars. Let's get right into it.
All right, Section 1, Business Model and Moat. Let's unpack what they actually do. Before we get into all these heavy financial statements and gigawatts of power, you've got to translate this for us. The terminology in this AI space, bare metal, Kubernetes, inference, computing nodes, that's too complicated. Could you give a simple analogy that even an elementary schooler could understand to explain what CoreWeave actually does on a day-to-day basis?
Certainly. Imagine a massive, state-of-the-art shopping mall. But instead of clothing stores, this mall is filled entirely with the most advanced, expensive supercomputers in the world. CoreWeave does not build the actual computers, Nvidia builds those. Nor do they build the AI applications like ChatGPT, software companies build those. Instead, CoreWeave buys the absolute best computers available, puts them in highly specialized buildings with massive amounts of electricity and industrial cooling, and then rents them out to AI scientists and tech companies who need temporary, immense brainpower to do their homework.
So what you just said basically means they are the landlords of AI compute. They literally just buy the most expensive toys on the market and rent them out by the hour?
Precisely. They offer what the industry calls bare metal access to the latest Nvidia GPUs. Bare metal simply means the customer gets direct, unshared access to the physical hardware, which eliminates any performance bottlenecks you usually get when sharing servers. According to their corporate filings, their core objective is providing purpose-built cloud infrastructure specifically for training and serving large AI models. They are effectively the specialized real estate layer sitting directly between the chip manufacturers like Nvidia and the AI application developers.
To understand their current competitive position, we really must track their historical evolution, which is entirely data-driven. If you look at the timeline data, in 2017, they were actually founded as an Ethereum cryptocurrency mining operation. The pivot to AI was driven by three quantifiable factors. First, the profitability margins of crypto mining severely degraded over time. Second, the release of generative AI caused a vertical spike in demand for the exact same GPU clusters they were already operating. And third, the legacy cloud providers like AWS and Azure were burdened by generalized infrastructure that could not optimally route data for massive AI workloads.
Oh my God, really? They started as a crypto mining outfit in New Jersey. That is a wild pivot. So they essentially realized their crypto mining rigs are perfectly suited for the AI boom. But looking at the data, the 2023 milestone here is absolutely fascinating to me. They secured $2.3 billion in debt using Nvidia H100 chips as collateral. They literally used computer chips as currency to get a loan from Wall Street. And now, in 2026, they are surpassing 1 gigawatt of active power and joining the NASDAQ 100. That is an explosive trajectory.
Yes, and that 1 gigawatt figure is incredibly critical. To put that into perspective, 1 gigawatt is roughly the power required to run an entire medium-sized city. By the end of Q1 2026, they surpassed this threshold of active power and actually reported 3.5 gigawatts of contracted power. This power capacity is not just a vanity metric. It is their primary operational bottleneck and consequently a massive barrier to entry for any new competitors trying to enter the space.
Now let's examine their economic moat. A logical question is, why wouldn't a customer just use Microsoft Azure or Amazon Web Services? The answer lies in their specific architecture. According to CoreWeave's performance benchmarks, their Kubernetes native environment, which is essentially a specialized software orchestrator, delivers up to a 20% improvement in system model flops utilization, or MFU, over comparative legacy clouds.
Wait, 20%? That sounds like a massive efficiency gain when you're talking about companies spending hundreds of millions of dollars on compute time.
It translates directly to the bottom line. A 20% MFU improvement means customers require significantly less infrastructure to achieve the exact same performance, drastically lowering their total cost of ownership. The data shows that legacy tech giants built their clouds for millions of small, disjointed web applications. CoreWeave, on the other hand, built their stack entirely around what they call CoreWeave Mission Control to manage mega clusters of over 100,000 GPUs working simultaneously on a single AI problem. It is an irreplaceable technological weapon in their arsenal.
All right, let's move to our next section, unpacking the financial surge. So what you just said basically means their infrastructure is like a custom-built high-speed Formula One racetrack, while the legacy cloud giants are forcing these AI models to drive on regular congested city streets. That is a brilliant moat. But I want to play devil's advocate here for a second. Tech history is littered with companies that had great products but fundamentally broken financials. Let's look at the hard numbers. Are they actually generating real, sustainable revenue, or is this just venture capital fairy dust? They are making good money, so why is the stock price like this? The financials are highly robust, and it's proven by the numbers. Notice the exponential rather than linear growth from their Q1 2026 earnings presentation. In Q1 of 2025, they posted $982 million. By Q4 of 2025, that climbed to over $1.5 billion, and in Q1 of 2026, they shattered records with $2.078 billion in a single quarter. This represents a staggering 112% year-over-year revenue growth.
Over $2 billion in a single quarter? That is serious cash flow. But who's actually paying them this much money? Is it just a bunch of AI startups burning through their seed funding, or are these real established companies?
The customer profile has fundamentally matured. The Q1 earnings call specifically cited that quantitative trading firms and major financial services are driving this massive adoption. Jane Street, for example, expanded their commitment with a $1 billion investment into CoreWeave's capacity in Q1 alone. Furthermore, the CEO noted that over 50% of their compute is now being used for inference, meaning running active, revenue-generating AI applications for end users rather than just experimental model training.
This proves the revenue is sticky and deeply embedded in actual enterprise operations.
Which brings us to our third section and the heart of the controversy, the cost of hyperscale.
Wait a minute, doctor. What does this massive revenue have to do with our stock accounts if the company is bleeding cash? I was reading the fine print on these earnings, and they were reporting a massive net loss. Why is the market going wild when they are running such a steep deficit? You are highlighting the exact friction point of their entire financial model. To understand the deficit, we must analyze the timing of capital expenditures versus revenue realization. It's proven by the numbers on the high and low side. On the high side, their adjusted EBITDA for Q1 2026 was $1.2 billion, which translates to a highly lucrative 56% margin. This proves the core unit economics. Renting out GPUs is wildly profitable. However, on the low side, they reported $6.8 billion in capital expenditures for the quarter, resulting in an adjusted net loss of negative $589 million. A $589 million loss in 3 months? How is that sustainable in the long run? It is a strict function of data center physics. That $6.8 billion in capex is required to buy the land, build the massive facilities, install the power grids, and purchase thousands of Blackwell and Hopper GPUs to fulfill that $99 billion backlog we discussed earlier. Data center deployment expenses are incurred heavily up front. They spend the money months or even years before a single GPU is powered on and generating rent. Therefore, the net loss is a reflection of aggressive future capacity expansion, not a failure of their current daily operations.
So what you just said basically means they have to pay for the entire apartment building upfront before they can collect a single dollar of rent from the tenants. I get that. But here is my contrarian question. Is this borrow-to-buy model a fatal risk? We know they are using the GPUs themselves as collateral for these massive multi-billion-dollar loans. What happens if the hardware cycle shifts? What if Nvidia releases a chip that is 10 times better tomorrow, and suddenly the chips CoreWeave used as collateral are completely obsolete?
That is the defining vulnerability of their economic moat. The risk is not hypothetical. It is clearly outlined in their 10Q SEC filings. Their future growth is entirely dependent on accurately estimating the useful life of these GPU components. If the broader adoption of AI slows, or if technological innovation accelerates faster than their depreciation schedules, the collateral backing their massive debt could severely devalue.
According to the recent analysis from Simply Wall Street, this extreme reliance on debt-fueled growth makes CoreWeave a high beta play on the AI cycle. High beta means the stock will exhibit extreme volatility relative to the broader market.
So it's a roller coaster. You strap in and you go way up or way down depending entirely on Nvidia's product roadmap.
Precisely. If you look at the data, they have secured over $20 billion in debt and equity year to date. If macroeconomic financing conditions tighten, or if the exorbitant margins in the GPU rental space shrink due to competitors finally catching up, there's a significant asymmetric risk to the downside. They are heavily leveraged on the premise that AI compute pricing will remain perpetually elevated. If pricing normalizes to historical cloud standards, their debt servicing costs could absolutely suffocate their cash flow.
That is a terrifying prospect if you are holding this at the top of the market, which perfectly transitions us to our final and arguably most important section, valuation scenarios.
I need a translation of all these abstract numbers into actual market implications. So what? Is the stock currently overvalued? Are retail investors late to the party right now? Let's give our viewers the cold, hard forecast. To forecast objectively, we must look at how the market is currently pricing their future cash flows against the known risks we've just detailed. The central question the market is wrestling with right now is whether the current stock price already has all of this $99 billion backlog and hypergrowth perfectly priced in. If it does, there is no upside left for new investors. Simply Wall Street conducted a comprehensive risk-reward profile comparing CoreWeave to its peers, focusing heavily on how long the current hardware cycle can support these elevated valuations without severe cash flow relief. And what did the numbers actually spit out? Don't hold back on us, give us the data.
The quantitative result is stark. Comparing their recent trading price around $95.61 against the calculated fair value of exactly $70 indicates that the stock is mathematically calculated to be 36.6% overvalued at current levels. Whoa! 36.6% overvalued? That explains the recent 17% month-over-month drop we talked about in the intro. The market is waking up to the debt reality. Exactly. The discrepancy between the $95 price and the $70 fair value hinges entirely on punchy revenue expansion assumptions. The market has been pricing CoreWeave at high-growth tech multiples, like a software company.
However, as their capital intensity becomes undeniable, the data suggests the market may eventually re-rate them down to lower-tier financing company multiples. If you require $6.8 billion in hard capital to generate revenue, you are priced more like a railroad or an airline, not a pure software firm.
Therefore, based strictly on the source data and market preconditions, we can model 3 specific survival scenarios for investors to watch moving forward. First, the bull case, the optimistic scenario. The precondition here is that enterprise AI demand remains relentlessly resilient and macro financing conditions ease, perhaps through federal rate cuts. If over 50% of compute continues to be utilized for revenue-generating inference, that $99 billion backlog converts to free cash flow rapidly, masking the debt burden. This justifies a return to the $100+ share price. Second, the base case, our neutral expectation. The precondition is that the current Hopper and Blackwell hardware cycle remains the industry standard for the next 24 months. The massive capex continues, the company remains technically loss-making on a net basis, but the sheer volume of top-line revenue supports the current high multiples temporarily, keeping the stock in a volatile trading range right around its current price. Finally, the bear case, the pessimistic outlook. The precondition is that the stated risks materialize. Competitors aggressively slash GPU rental prices, or next-generation chips render current collateral less valuable. If this triggers a margin contraction, the market will aggressively re-rate CoreWeave from a tech multiple to a financing multiple. This scenario aligns perfectly with the $70 fair value target, representing a significant downward correction.
So, what you just said basically means the company's walking a tightrope. They are sprinting forward with billions in debt, betting that the AI music never, ever stops playing. It reminds me of the famous stock market quote by Warren Buffett. Only when the tide goes out do you discover who's been swimming naked. Right now, the AI tide is historically high. As their CEO, Michael Intrator, noted in the earnings call, they are in a privileged position where demand is so high they actually get to pick and choose their clients. But if that demand normalizes, that massive debt load will be laid bare for all investors to see. Doctor, thank you for providing such a cold-headed, rigorous breakdown of the numbers today. And thank you all for watching today's Explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our Explainer. Keep doing your research, stay focused, and we will see you in the next one.